On today's episode of the AI Investor Podcast from 24/7 Wall Street, we'll discuss what a Trump presidency means for the AI landscape, dive into some recent earnings, and share 4 trades Eric is making in the portfolio. All of that is next. Welcome back, everyone. I am David Hanson, and I am joined, as always, by Eric Bleeker. Eric, there's been absolutely nothing newsworthy, nothing going on in the world this week. No, market's been just totally sleepy. Why are we even doing a show this week?
Same as it ever was. I mean, if you're not making 3% a day, why'd you even wake up for the market right now?
Well, that's what we aim to deliver on the AI Investor Podcast. We've got a good show, like I said. You're going to be making 4 trades to the portfolio. We're going to get to those in just a bit. We're not going to save those till the very end. We're not going to hold that in suspense that long. But I did want to start off by looking at the larger cloud companies, the hyperscalers. They reported earnings just about right after we did the last show about 2 weeks ago. So we've had some time to digest what those earnings mean for those companies and the AI landscape. And of course, I'm talking about Microsoft, Amazon, Google. Those are the huge cloud players in the AI space right now. So I wanted to just get your take on what did you learn from those earnings in terms of read through, what it means for other companies now that we've had some time to digest those earnings.
Yeah, and in one of the earliest podcast episodes, you said, what are you watching in earnings? And I had said, I'm often watching hyperscalers and what are they saying about the market? Because that's one of the most important areas to watch. So I think we're a little overdue to break down kind of who the hyperscalers are, how much money's flowing through them, et cetera. And as you know, they all just report earnings. So this is a great time to kind of take stake of the overall AI industry. So when we talk about hyperscalers, that's just the largest cloud companies that they drive sometimes more than 50% of kind of revenue into the AI space. And, you know, that sounds like a lot of concentration, and a lot of this work does go to them internally. But also, a lot of this work is for customers, right? Cloud computing, as people come, they basically rent computing for a cost. It turns kind of your computing infrastructure into a service. And so it's a little bit more complicated than that. But what we had in the year, well, I should note first, too, who are the hyperscalers, right? I shouldn't take for granted people know that. It's Meta, which is Facebook, Microsoft, Amazon, and then also Alphabet, which is Google. And as a group, what we're watching with them is their capital expenditures. Because, well, there's different things that can go into a capital expenditure bucket. It's mostly kind of data center spend right now. That is the biggest expense item. And what we had in 2023 was relatively flat capital expenditures. The group as a whole spent $154 billion. Now, I've got the numbers in front of me. This year, they're spending $240 billion, 56% growth, right? So you can see where a lot of the returns in AI are coming from. Now, the bigger picture, of course, too, is we're constantly looking for where is the future going. And at the start of this year, with NVIDIA already running and all these stocks, and people go, there's so many gains for an NVIDIA in 2023 and a lot of these AI stocks. How are they also seeing gains this year? Well, if we go back to the start of 2024, the expectations for spend in 2025, the year ahead, at that point, Wall Street had it at $194 billion in spend. As of today, those estimates are for $301 billion. The expectations, not for capital expenditures right this year, for the next year have gone up more than 50%, right? So David, you've been investing long enough, you know, generally when that happens, when you are that far ahead of consensus, right, you're going to make a lot of money in the stock market, right? So let's look. We've got $301 billion now as the estimate for spend for next year. What does that represent? Well, it's still 25% plus growth rates. Also, we look ahead to 2026. What Wall Street will do is you can actually look at Wall Street estimates and know when they're kind of throwing their hands up and saying, we don't have any idea. And they just take growth and put in single digits, right? So you'll see 50% growth, 40% growth, 8. We're already seeing growth rates for 2026 come up to where they're at. It's about $336 billion right now. So that's 12%. So we're already starting to see some of the uncertainty removed from 2026. So effectively, in just the past 6 months, why is NVIDIA back at all-time highs? Why have all these AI stocks done so well? Well, it's because of this kind of uncertainty being removed. 2025, the spending right now, NVIDIA's called it insane. I've seen other customers call it insane. And the uncertainty continues moving further and further out. So, David, I want to pause for a moment, to give, you a chance to ask any questions, or, we can move the discussion forward. But I think there's two important notes for everyone out there about what's going on with this hyperscaler spending. First, it's relatively new that this data center spending is going to categories that support AI. That's memory, GPUs, a lot of this kind of newer networking spend that I've been talking about. The vast majority of data center footprints, the actual data centers, is for legacy infrastructure. So that's CPU-centric infrastructure. So let's say there is 25% plus growth rates next year. Well, that might mean that AI-centric growth rates are 60%, and legacy growth rates are negative 30%, right? Those aren't specific numbers, but it's illustrative. So it shows how if you're investing in AI, you might say, well, it's 25% growth to data centers next year, but NVIDIA is actually projected to grow higher. That's how, right? They are only levered to the AI side. Second, the growth rates of these large cloud companies are very reliant on AI growth, and we can kind of break down exactly what that looks like next. But if you're a Microsoft, if you're an Amazon, if you're a Google, right now, if you were to stop spending, turn the rockets down, the crown jewel in your portfolio of assets, your cloud computing division, would all of a sudden see its growth decelerate massively. So they don't really, do they have the option to keep spending this way? The stronger incentive right now is, do they have the option to not do it? Because if they turned off the jets on spending right now, their growth rates in their cloud computing would collapse, and it would be a bigger hindrance to their share price. And we could talk a little bit more about the why of that coming up. But again, I wanted to kind of pause it there because I think that's a very good overview of kind of the hyperscaler market. If you want, David, next, we could kind of break down, we could go down and look at a more individual company level, but whatever's most interesting.
Yeah, I definitely want to go down a little bit more into the company level and talk about specifically the ones in our portfolio, but at this kind of 20,000 foot view of the AI market, it seems consistent with what you're saying, with what we've heard from other investors. Again, I harken back to a month ago, David Tepper being like, I feel great about 2025. 2026, 2027 is less sure to me. So it makes sense that there's this kind of expectation being set by the market that there's not a lot of visibility into 26, 27 in terms of where are we going to be higher, lower than what consensus is now. How do you get comfortable figuring out where you are on that side of the fence? Is it looking at, hey, is the models and the capabilities of AI, is that what we need to be watching in terms of the improvements seem to be getting better? And as long as the models and the capabilities are getting better, that would suggest that growth is probably going to be above what these, again, Wall Street analysts plugging in 8% growth. Is that what you're looking at to feel confident on where you might be on kind of that over under, for lack of a better way of thinking about expectations in those out years?
Yeah, I think there's definitely a few things you want to look at. Number one, do all signs that you're reading say that the capabilities of these models continue increasing? Is there something out there that says that we are approaching some kind of limit to growth? The other side of that is, are there more capabilities coming out there that's going to drive usage? We've talked a lot about agents and some of the catalysts for this next year. So I think you're looking at that. The third thing I'm looking at is really individual commentary from these companies and kind of to how Wall Street is treating these companies. Because I kind of got into this a little bit at the end there of saying, well, the bigger risk right now is kind of taking down this spending because it would remove a lot of the growth rates. So one question is, at some point, is Wall Street going to react really harshly to the level of AI spending and cause some kind of change for these companies? And there was some kind of almost signs that was happening at the start of earnings season, but I think that was potentially a little misread. And David, if you wanted, I could go into the details on that. But I would say overall, from this past earnings season we just went through, if anything, I think it was incredibly bullish for people in the AI space that we're going to see some very significant spend in 2025 that, again, it was ahead of the consensus at the start of the year, but it's even ahead of the consensus a few months ago.
Right. And I think maybe on a future episode, it would be good for us to spend more time breaking down. Let's go through that bear case where AI, kind of the promises or the productivity gains, don't materialize, because I think it's we hear so much from the AI advocates, whether it's Elon Musk or Jensen and NVIDIA, just saying, hey, we're going to have to redo all computing in the whole world. When you hear that, that definitely seems like this is going to be a big 2027, 2028 story if you're re-architecting the whole world and how it's computing. So it's very easy to see the bull case and how spend continues. But I do think on a future episode, we should spend some time playing the skeptic. Not that we have to be skeptical, but I think it would be worth kind of going through that case. So let's save that. But let's dive into the portfolio. What are you hearing from some of these smaller companies? Because we talk about the hyperscalers. None of those are currently in the AI portfolio that we've been talking about and managing in full view on this show. So let's dive into the portfolio a little bit. What have you been hearing? And then after that, let's talk about the trades that we're going to be making.
Sure. Yeah. I think from a portfolio perspective, the big pictures is companies with the most exposure to this AI centric spend. It's been almost universally a very good earnings season. Kind of remarkably so, because, I've said since the start, David, right? We've got kind of different spending categories. The first thing that we saw was companies just want to buy as many NVIDIA chips as possible. And that was kind of the first wave of AI spending. The second wave is going to be they want to build these massive clusters. They're going to need a lot of networking. It's going to lead to a lot more categories growing. We've tried to get exposure to that in a variety of ways. We've done Coherent and Credo with optics. We've tried last week. We went more into Vertiv and Schneider Electric as kind of the infrastructure play. And then, of course, we have, the mainstays where we've got, Broadcom as a combination of networking and also its chips. And then we have companies like Taiwan Semiconductor as kind of arms merchant across this entire space. What we're really seeing right now is companies in that Coherent category have had an absolutely incredible earnings season. So I'll just pull up the numbers for Coherent here. Number one, it was up 10% on Thursday. We're filming this on Friday. As of today, it's up 45% since we announced our intention to buy it. Obviously, great return in 2 months. An EPS of 74 cents versus 61 cents expected. But this was just the first of many companies in this optic space that has just announced really blowout earnings. And the commentary, you really got to go in and read the earnings calls and see what they're saying. This is a cyclical industry. It carries some risk, but you rarely see the levels of enthusiasm you're seeing right now. Lumentum, which is a competitor, they issued projections for next quarter of $390 million in revenue versus expectations of $354. Earnings were 35 cents versus projections of 27. They're up. David, I don't know if you can pull up. I think it's up 16% today. I honestly expect it to be a bigger jump than that. And this is a point that I've made where you have very acute needs, and whether or not something is a bit of a commodity or not, when there's only so many players and you have really acute needs, you're going to have significant margin expansion in a short period of time. Another company I've talked about on the podcast before is Applied Optoelectronics. I've said I personally own call options because I liked the potential for some of their engagements to really go up. Again, this is a company, last I looked, was up 25% today. It was up 10% yesterday. It's seeing huge takeoff. They're talking about more wins at, diversified cloud providers. And they're basically saying we are scraping together all the cash we can to do a massive build out next year because of all the business that's coming in. I mean, it is incredibly bullish to listen to these companies that are kind of in this first phase of these data centers, that, again, re-architected for this AI world. Now, I think we need to just look at, we've had Coherent, as I mentioned, and Credo very tightly to this trend. I wish I'd been more aggressive, right? But we also want to keep risk in check. Like, let's face it, like a Broadcom is just going to be a lot less risky than Applied Optoelectronics. When I bought my options on it, they were worth $300 million. It's a tiny company. These are, Coherent is the largest and safest one of the bunch, and it's worth some like 15 billion. It might be worth more with how much it's gone up. Lumentum's worth 6 billion after today. But the takeoff is really happening in this area. You know, David, we got a listener question asking us about Astera Labs. It's a company I've been listening to. I tried getting to it last episode because I wanted to talk about them because they are very levered to this AI spend. And guess what happened with their earnings? They were up 33% the next day. They're up 78% in the next month. And again, you look at Astera Labs, a big part is they don't have that leverage to the prior kind of architecture of how you built data centers. So when all this spending comes in, so upside to them. And we're seeing the companies that get the upside for this next wave and lack that downside. They just see the biggest gains as the spending really accelerates. So I would say I'll talk about two other areas I think are important for the portfolio. But the number one area that I've been seeing is a lot of these initial supplier plays that really hint towards this next wave of spending. They're starting to issue extremely bullish earnings that point to really intense revenue acceleration across all of 2025. So I'll pause it there for a moment. Any reactions, or we can kind of move on to some other earnings areas?
Yeah, I mean, I think we talk about this second wave, the first wave being NVIDIA. It seems to rhyme right now. We talk so much about the explosive stock price gains that NVIDIA has had over the last couple of years, but paired with it was the earnings growth. So it wasn't just this, multiples are just getting out of control. You're seeing that inflection point that you've talked about with so many of these companies, that we might be nearing this inflection point of them just stepping up a next level in terms of performance. I also just, I've said a few episodes ago, I talked about how these companies are seeing such explosive growth in top line, in share price. I want to mention, you threw out this word a couple of times, earnings per share. These are profitable companies. Again, just such a different breed of companies from what so many kind of quote unquote tech investors were invested in over the last 10 years, where it was like, hey, we got explosive top line growth, but the unit economics just aren't working and we're losing money on every single sale we make. So this is such a different type of tech investing versus, hey, I'm buying Snapchat, even though they're losing money every quarter. So I just want to underline how different that is when you can even say earnings per share versus, hey, they didn't lose as much money this quarter.
Well, and I didn't even tell you I wanted to talk about this next company. You just read my mind on the theme, but I wanted to talk about this profit acceleration. Look at us. We're 6 episodes in. We're like Mike and Mike here, just building off each other. But I want to talk about AppLovin, which is a candidate for the highest returns in the past 2 years and the worst named company you could buy. I mean, how many people out there know what AppLovin is? But this is now an $80 billion company. They reported,
and this is ticker APP, right?
Correct. They were up 46% the next day, which is incredible. And this is a company, they're an ad network for mobile apps, right? And what they did was they went and they built a network of first-party data. So they were essentially able to train their models. And this is kind of what Facebook has done. Apple, I don't want to get too in the weeds about this, but Apple had this famous kind of episode where they, in the name of privacy, but probably more in terms of protecting their competitive advantage, they got rid of basically these unique identifiers. They're called IDFA, where you had to opt in to give any information. And it really left Meta scrambling, and it led to the episode where they, in the fall of 2022, went all the way down to $80. And Meta kind of got out of this by they took AI, they made it their competitive advantage, and they used artificial intelligence to basically be more predictive about advertising. And they set themselves up for a world where they're actually kind of more efficient than they were under this old world. And AppLovin did the same thing because they had that first party data. It was a really genius move. And since the start of 2023, I mentioned Facebook hit its nadir in the fall of 2022. AppLovin hit its nadir at the same time. They are up 2,200%. NVIDIA's up 940% that time. And it's a software company. It's an AI play, and no one's thinking of it. And the why on this, David, and this is exactly what you're talking about, is because every incremental dollar that they've been making off kind of these AI initiatives to make their advertising better, they're getting something like for every incremental dollar, they're getting 80 cents in profits back. So a lot of people, you need to understand a bear case for AI. And as we've said from day one of the show, it cannot be up 15% every month. I had someone the other day who said to me, I've got Coherent. That one's been kind of up and down since you recommended it. I'm like, it's up 45% in 2 months. It's very good. We got to remember, like, market in general, you're hoping for 10% a year. But sorry, it's crazy time right now in the market. But a lot of people who put out the bear cases on AI, they are saying that look at the price to sales multiples. Well, if you look at the price to sales multiple on a company like AppLovin, it's insane. It's totally insane. It's one of the highest things. But if you're a company that can turn a lever that for every single incremental dollar in sales, you're doing 80 cents in profits, we've never seen anything like this in the history of the market before. I mean, this is like, if you've ever had the thought exercise of how much would Google be worth instead of, all the, free massages and 2 employees and dinners and 150,000 people, if they just optimized every penny of Google search for profits. This is essentially what you have, and you're being able to watch. And it's a company that, again, it's up 22%. So, this shows companies that are often in the bullseye of AI, they are driving revenue, but they've been able to actually drive profits at a level unlike we've ever seen in any trend before. And this is going to be continuing. I look at AppLovin, and this is a big question, and it's really taking kind of a complicated company and making it as simplified as possible. But I'm like, are there any other companies with first party data that we just don't appreciate what they're going to be able to do, turning on more powerful AI algorithms in the years to come? Because if this is an example, you only need to find one company like that to change your life, right? If you held AppLovin from 2023 to today and it was a 5% position, your life has changed. You've beat the market for the next decade, like, job done. So, it's something that's bouncing around in my head right now, and is this profit situation, which I don't think we've talked about, the ability of companies with this first party data to get incredible operating leverage. And I think there's going to be some incredible success stories that are below the radar. Because again, a company with 2.5 times the returns of NVIDIA in the last 2 years, and right, who's heard of it, right? What percent of listeners have heard of this? 5%? I don't know.
Yeah. So certainly a big trend, and we talk about so much on these first 5 episodes about the infrastructure of AI. Obviously, what you're kind of hinting at is there is a third wave then of we've built the infrastructure. Now there's these companies implementing the technology, and that inning might be the longest inning. That might be a 10-year story, and there's going to be lots of losers too in that space of companies that missed the AI opportunity, which is probably fueling a lot of the spend now. Companies are afraid of missing that, and their competitors utilizing the technology and leapfrogging them. So I think that it doesn't feel like we're there yet in terms of the narrative of the market. In terms of when people think about AI, it has been so chip focused, infrastructure focused. We haven't quite got to that software part, but it certainly seems like an inevitable. There will be more AppLovins. I don't know if they'll match the names, but it seems like there'll be many more.
Let me pause right here and just say another example of where this could be playing out in the portfolio right now. So Synopsys is one of the earliest companies we recommended. They make the software to design chips. And one of the reasons I recommended that was I think it's, historically a tremendously well-run company. But I said, I think AI is going to make the software they sell incredibly more valuable, multiples more valuable. And they're not just going to grow with the chip market. They're going to, if you think the chip market's going to be big, I think they're going to grow at well above that rate. So their primary competitor is a company named Cadence. Their CEO came out here. What do you say? He said AI is going to triple their addressable market, and overall sales of their AI software that they've been releasing was up threefold last quarter. Now that's off a small base, but you're starting to see some of this come together. It's like, okay, well, that's a software company, and it is pretty chip adjacent. They make the software for chips, but they're already talking about their ability to drive incredible amounts of profit leverage off their software. So maybe we've got one in the portfolio right now that's already seeing this play out via Synopsys, and we should honestly probably, you know, incorporating that knowledge, either buy Cadence or increase our stake in them in the weeks to come. You know, this is where we're always trying to incorporate, you know, this new stuff going on, but you know, you can see the power of this, that these companies, they probably will see incredible profit margin expansion in the years to come.
Well, this is a free podcast. We don't ask for anything, but maybe we have our listeners out there. So maybe if there's someone who maybe we can put in a call to identify companies out there. Is anyone out there listening, looking at some companies that they think might benefit from more of that app love inside of things, a software company where maybe applying the technology can really accelerate their business? So you can send us those at questions@247wallstreet.com. Send your suggestions as well. Maybe you can give us some fodder to look into. So I wanted to move into the buys that we're making in the portfolio. You have a few new companies that you're adding. You've already mentioned some of them by name, but let's go into specifics of the new companies you're buying and then the company that you are adding to as well.
Yeah. So first of all, let's just talk about Marvell. So Marvell, ticker symbol MRVL. I'm going to add $25,000 to them, which that's pretty big, right? It's a 5% position, but I really just like what's happening to them in the near term. And we talked about the overall picture of cloud computing. If I could collapse a little bit here to talk about the drivers behind Marvell, there's a very interesting near-term catalyst happening to them. The run rate for different cloud companies, if you're looking at, as I noted earlier, there's 4 hyperscalers. Meta doesn't have a cloud computing division. They use all internally. Amazon Web Services, that's $110 billion in run rate. Microsoft Azure, it's about $66 billion. Google Cloud, it's about $45 billion. I got that from Altimeter Research. Now, growth rates wise, here's what's different. Google Cloud is growing the fastest at about 35%. So small is growing the fastest. Azure is growing at about 34% in constant currency. Amazon Web Services, 19%. And if we look at their bookings last quarter for annual revenue run rate, Amazon was at $4.6 billion. Microsoft 4.3, Google 4. So, right, like they're growing in larger percentages and in absolute numbers in the recent quarters, they're kind of catching up. And the reason is both of these companies did a lot to court AI companies and kind of AI workloads. And with Azure, they release every quarter. They say we had 34% growth last quarter. If we didn't have our AI business, it would be 21. That's what I was talking about earlier, David, where I'm like, if these companies didn't have AI for their cloud businesses, their growth rates would look very pedestrian right now. They would not be valued at anything close to the multiples they are today because it wouldn't look like they have the same kind of open-ended future that they have. So Amazon, they realize this is a problem. It's all hands on deck. I think they're going to be amongst the most aggressive spenders next year. And they're really putting their bets on their custom chip, which is Trainium 2. Right now in the news, as we're filming this, it was just broken. They're trying to get the kind of rival to OpenAI, Anthropic, to take an investment that includes needing to use their homegrown Trainium 2 chips. The reason is they're ordering a ton of them. They need someone to use them. And who designed Trainium 2? It's Marvell. In addition, Marvell has huge tailwinds in all the other areas I'm watching right now and think have big growth in 2025. We can look at the interconnects, kind of the networking technology inside the data center, and who has the most substantial market share in that. Well, you look at across categories, Marvell's close to the top. You look at connecting multiple data centers together. You know, we've talked about how we might be connecting data centers to do these big training runs. Who has a pluggables market for a lot of these optics that's seeing some of the biggest growth? It's Marvell. So it's kind of whenever I look at a category and think who's going to see the most growth, Marvell lines up very well with that. And they just get this kind of near-term catalyst from Amazon being the one cloud company that needs to spend the most. So I'm doing a larger investment in them because I think it's strategic and potentially a little short-term. So would I be averse to taking that down if we get a quick 30 or 40% growth on it? Maybe I'll reallocate that to other companies. But I like where they're strategically positioned for 2025. And I should say too, there's a great blog. They've really been hammering this. It's named Fabricate Knowledge. If anyone once more of the Marvell story. They've been covering that well. Rest of the portfolio buys, I'm going to do 10K to Fabrinet, ticker FN, 5K to Lumentum, that's ticker LITE. Then I'm going to add another 5K to Coherent, even though they are up 45%. Would have loved to have just done 15,000 initially to them, but that's how the cookie crumbles. And David, I already talked earlier. I don't need to rehash anything. I talked about Lumentum earlier. I talked about the momentum to the options market. I just think I haven't, optics, they're risky. It's a cyclical market, but I don't think, I don't want to get too risky. We're not trying to put people over the top with risk in this portfolio, but I also want to size opportunities according to risk. And I just don't think I've sized, the bet in optics according to what the potential upside is. So I just want to take the group up to $30,000, and we're going to do it as kind of a waterfall. Like least risky is Coherent, most risky, kind of more of a pure play is Lumentum. We'll get them all, but we'll size them accordingly. And over time, we'll be able to kind of move around. So David, those are the buys today. What we're doing, it's going to give us more exposure to some of the biggest trends that I'm seeing in 2025. It's going to kind of give us some more incremental play there. And it's going to give us kind of a large bet on a company that I think has some of the most impressive tailwinds headed into 2025. And that is Marvell. So any questions, I'm happy to answer them.
Yeah, just quickly on Fabrinet. This is a company that's been around a really long time. In the world of tech, it's been public for quite some time. I think almost 15 years at least. And is this an example of a company that has legacy businesses that maybe aren't growing quite as much or are slowing down, and then they have an aspect of their business that is exposed to kind of this new trend? Is that what you're seeing in this company that has been around it's been a great, successful company and stock on the market? But is it one of those examples of seeing that pivot in their business right now?
I mean, the big thing when you look across optics is essentially traditionally you had a primary customer of telecommunications. And here's the thing about telecommunications. There's no real incentive to drive up your capital expenditures because the quality of your service doesn't really impact whether or not you're losing or gaining many subscribers. So there's never as great a competitive dynamic in this industry. The newest thing is what we call data communications, datacom. And that's basically hyperscalers are replacing telecom as primary customers for a lot of these companies. So it's a favorable, it's a lot of these companies have existed for a long time. Coherent, they've had so many mergers and to where they get today. These are companies with long histories, but for the first time, they're kind of operating with new opportunities. So, I don't have, there's differences in like the exposure to NVIDIA. It's a little bit like at the start of smartphones of like, well, who's got Apple as a customer? And, there's advantages in who has exposure directly to NVIDIA. As I'll talk about in a moment too, there is some differences too in where their supply chains are, because increasingly, especially under a Trump administration, you're probably going to want your suppliers in this space to have domiciled in the U.S. as much as possible, or have supply chains outside of China. So I'm not overthinking it too much. And if I was being honest about the inclusion of Fabrinet, I thought the valuation was just a little bit more reasonable of the group. So I was trying to spread across exposure to it. So again, it's all of them. They might have different age and terms, but they're all, basically right now seeing the same industry dynamics of the new boss is a lot better than the old boss, right?
Well, speaking of new bosses, you mentioned Donald Trump being the president-elect, the news we got earlier this week. We obviously have to touch on a little bit what that might mean for the AI landscape, the tech landscape. He's got a new right-hand man to Elon Musk over the last couple of months, who obviously has been very outspoken, very pro-AI, believing it to be a great thing, but also, Elon has not been shy about highlighting the dangers of AI. So clearly this is something that is going to be top of mind with this administration, you would imagine, with someone like Elon Musk, who seems to have the ear of President Trump. So what were we don't want to get too far down the path of predictions or pontifications about what might happen with this administration. But we obviously have to spend a little bit of time digesting what does this mean for the companies that you follow. Do you think?
Yeah, I think, hey, if Harris had won, it would be a pretty straight line between, regulatory situation, what pieces of legislation they want to put through versus, the last presidency. So we do have a shift here. And if you're an investor, you don't want to get too high on building your entire portfolio around winners of a next presidency, but you definitely need to incorporate. The primary thing I would say about think about your portfolio and Donald Trump is essentially don't look too much into where any one issue is today. When he talks about tariffs, how much of that is a negotiating tactic, right? If you've got companies that might be impacted by that, it's definitely a net negative right now, but also it's very unclear what he wants his policy to be. Taiwan Semiconductor, the day after he was elected, was down while everything was up big. And then that night, some analysts issued notes saying they don't really think they would be impacted that much, and they were up 4% the next day. Meta, the day after he was elected, it was trailing other tech stocks by 3 or 4% because everyone's like, Musk is in there, he owns X, Trump has his own social media platform. That night, a bunch of analyst notes went out saying, hey, it's probably actually a net positive environment for Meta. Boom, they're up on Thursday, right? So we're just seeing a lot of shifts. You've got Elon Musk obviously very involved in the campaign. If history is any indication, will he be deeply involved in a year? Very unclear, right? Now, some areas I do think are a little bit more sustainable over a longer period. Mergers and acquisitions. We've talked about previously on the show, the M&A situation got bad enough on a global scale that in the last 4 years, Amazon couldn't even buy iRobot, which I think is now worth $7 a share and laying off the majority of its staff. There still might be some pressure in some of the larger tech stocks to not get bigger, but I think it's going to be a lot friendlier M&A environment, which is going to be good for a lot of smaller technology companies in general, because you've got one more takeout situation. I think accommodating regulations is going to be a big thing. You do have Musk's ear in the White House. He is dead set on the fact that, I don't know if I have a direct quote from him, but it would be something grandiose like AI is the battle for future civilization, right? And, Meta last week, they were trying to join the party and get their own, contract for nuclear reactors. I think I was blocked because there's some rare bees or something. So some of the environmental laws blocked it. I just think there's going to be pathways, right? If we have some, regulations blocking, we talked yesterday about 5 years of, connecting law of new energy to the grid. I think there's going to be some streamlining of moving the stuff. If there is a key bottleneck blocking the U.S.'s advantage in artificial intelligence, I believe this administration will be far more accommodating in that. And that's going to matter, because before it was, is this an existential risk to artificial intelligence? I believe that's more or less off the table for the time being. The final thing I would say is supply chains and made in the USA. I had just talked about with optics. I believe it was Lumentum in their earnings call. They've moved a lot of their production to Thailand. And they said it matters being a company domiciled in the U.S. with supply chain diversity. And I think companies are really going to be encouraged to, if you're a company that's over reliant on China, it's an issue. Also, in something like optics, there's a lot of competition for various components coming from China. There's a good chance companies won't want to save the 5%, 10%, 20% to have their products coming from China in this environment, which will really boost kind of U.S. rivals in those scenarios. So I think, David, we could go on for a while, but those are some of the key areas I'm watching. I'm already watching. I was really looking at optics earnings, thinking about that because they're already happening right now. But I think overall, the long and short of it is, if you needed one takeaway from this, it is you do have someone like an Elon Musk who is very influential in the campaign. He does believe AI is the single biggest issue in the world right now. And, you have to look at that as a tailwind for clearing regulation and basically forming a path for the U.S. prioritizing, basically winning this battle. And that's going to benefit the private companies involved with it, right?
Yeah, I mean, I think it's pretty interesting that, again, you have Elon, like you said, has been saying AI is the most important thing in the history of humanity, for lack of better words, or however he's phrased it. And it's really an issue that was not discussed in the campaign at all. So it might be a big issue with behind closed doors. It'll be interesting to see, where does this come up in kind of the public consciousness? When does it become a front page story? Because it really was not a talking point. Again, I didn't follow every single campaign rally and event on either side, but it did not seem like AI was a consistent issue or topic that either candidate was saying, this is something we have to get right. Again, it wouldn't be surprising if people around Donald Trump are saying that, but it'll just be interesting to see kind of, where do we get that public discussions versus what's being said in private. I think we don't know. Anyone who says they know exactly what's going to happen under the new presidency, I think they probably don't know either, but we'll see. So I think that's all we have. The sun is just absolutely shining on my face here in the studio.
Look,
that's probably a sign of, things are just going too well in the market. We're probably due for some sort of correction. It's 80 degrees and sunny in North Carolina here on a November day. So I'm not sure what's going on in the world. Too many good things are happening. But Eric, anything else before we sign off for the episode?
No, I think that covers it all. Like you said, maybe we'll take some deep dives in the future. We don't want to be too rosy. Things are going very well on stocks. Maybe at some of the risks. We want to make money for everyone here, but we also want to be extremely clear-eyed consistently about the risks. So maybe next show I'll put on my Dr. Doom hat and we'll roll from there.
Sounds great. As always, we have questions at questions@247wallstreet.com. Please send us any questions. Please leave us a review on Apple or Spotify. We would greatly appreciate it. And have a great week and weekend, everyone. People on the show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.